Good afternoon, everyone, and welcome to this session on BB Healthcare. BB Healthcare is a trust that's very actively managed in a high conviction approach run by Paul Major and Brett Dark. We've got Paul Major on the camera. It's extremely differentiated compared to many other trusts offering exposure to this specialist area, and one that inevitably touches us all. The managers look to invest in companies at the forefront of innovation, providing solutions to what they see as a broken healthcare system around the world, and they thereby seek to achieve capital growth well in excess of equity markets. Before I hand you over to Paul, a bit of housekeeping. We've got plenty of time for Q&A at the end. If you would like to type your questions into the Q&A box at the bottom right-hand corner of the screen, I'll put them to the manager and attempt to group them together so we get as many done as possible. Thank you very much again for dialing in. So over to Paul.
Thank you, William, and good afternoon, everybody. I'm particularly excited to have the opportunity to speak to you all today because the last sort of 48 hours have been quite interesting from a healthcare macro point of view, and I think this is genuinely a very interesting time to be talking about the sector. So what I'm going to do is give you a very brief introduction to Bellevue, an introduction to how we think about healthcare philosophically and how that then translates into the portfolio of investments that we have, and then really try and give you a bit of an outline of what the future looks like for our sector and for our strategy. So first, let's start with just an overview of Bellevue for you, for those of you not familiar. So we are a Swiss-based asset management company, have been running portfolios since 1993, very much biased toward healthcare as a sector. You can see a very unflattering picture of myself and my colleague Brett Dark at the top of this slide, but also an overview of the rest of the public equities team. So we run about 16 different healthcare-related strategies across 3 groups within the company. And as I say, we're very much known as a healthcare specialist operation, which helps us greatly with corporate access and getting access to IPOs and all sorts of interesting things like that. So let's have a bit of an overview of healthcare as an industry. Now, I think whenever one presents at an event like this, where you have all sorts of different kinds of funds, there are probably few managers who can be as clear about the long-term demographic outlook for growth in their sector as somebody who covers healthcare, because this is a demographically driven, demand-driven sector. There are ever more people in the world. Those people are ever older, and as you can see in the bottom left-hand side of this slide, there is a very strong correlation between age and healthcare utilization. As you reach middle age, we were never really evolved to live as long as we do, and consequently things start wearing out, and the wonders of modern technology and modern medicine enable us to continue to live for many, many decades beyond that. And so this is a sector where, as far as anyone wants to predict into the future, decades potentially, you can see growing demand for the services that are on offer. In addition, the range of services that are on offer continues to improve year on year, because we are still in the early innings of unpicking at a sort of molecular level what different diseases are and therefore how we can address them. So we have an underlying demand growth side from demographics. We have that compounded again through an innovation related aspect. So what we're looking at is a sector that's going to deliver, 3, 4, 5% underlying volume growth year on year for a very, very long time. Now that is an absolutely wonderful and fantastic picture, apart from one small problem, which is someone somewhere has to pay for all of this. And when you think about healthcare utilization being predominantly in the group of people who are over 65, they are obviously not economically productive in the same way. Many of them are retired and therefore not contributing to tax revenues and other things. So consequently, it's everybody else that has to pay for this. Now we've got 3 different elements on the slide in front of you. The first is you can see that because of those demographic drivers that I talked about, the upward slope in healthcare spending is relentless. It's not linked to the economic cycle. This is not a cyclical sector. It doesn't matter if the economy is growing or shrinking, if there is a recession or if we're in a boom. Healthcare will grow and grow and grow. And because of those demographic drivers and that innovation that we talked about, the rate of growth is generally higher than the rate of growth of the rest of the economy. And you can see this in the middle of this slide. So this is showing you CPI, which is the line for the US, both over the recent time and also projected by the US government into the future. And what you can see is in every single year, healthcare cost inflation exceeds CPI. So in other words, if we carry on as we are today, healthcare will consume all of our marginal wealth creation. And that bottom left to top right chart will just continue inexorably. The other challenge with the system that we have is really a practical one, which is that most of the healthcare systems that exist in the world today are a product of ideas coming from the end of the Second World War, the so-called post-war settlement, where there wasn't really a public health system, but it was felt appropriate to put one in place for all those soldiers coming back who'd fought for us. And so we have a system that was designed to deal with a range of problems that aren't the problems that we face today. You cast your mind back to the demographics of the 1940s, 1950s. People didn't live many years beyond retirement. They tended to die of acute medical problems like cardiovascular disease or infectious disease. They didn't live long enough to experience the chronic conditions that we struggle with today. So the system we have isn't designed to cope with the volume of work that it has, and it's not designed to cope with the diseases that it's facing. Consequently, what we find is tremendous wastage and misallocation of resources. So roughly speaking, 25% of all the things that doctors do with patients are a waste of time. 25% of all the dollars that are spent are a waste of time. And if you were fortunate enough to go to medical school or nursing school and learn to become a doctor because you're very idealistic and you want to help humanity, the tragic reality is that when you qualify and you actually get out there, you're going to spend roughly a third of your time doing paperwork. This is not the system that anybody had in mind when they set out, but that is in fact the reality of the situation that we face. Where does this leave us? Well, it leaves us with a very stark choice. So if we carry on as we are today, the healthcare system will consume all of our marginal wealth creation, which is obviously unacceptable. If we try and ration healthcare spending, as has been done to some degree here in the UK, for example, the system will simply collapse under the weight of demand. That is also not acceptable. Therefore, the only option that we have is to fundamentally and profoundly change the delivery paradigm and how we think about healthcare from the start to the end, and can do everything completely differently. Now, the great news for society, and the great news for us as investors as well, is that the products, services and technologies to enable us to do this in a very, very different way, they already exist, and many of them have proven and demonstrated their value, both in terms of maintaining or improving outcomes, but also in terms of making the system scalable and more efficient. So we can have a different healthcare system to the one that we have today. All that matters now is really the political will to make those changes and to accept that we have to do things. And the pandemic has been an interesting opportunity to accelerate some of those changes, as I'm sure many of you who've had for the first time a virtual interaction with your doctor, for example, will have seen. So let's talk about the future for a minute and what healthcare looks like moving forward. So before we do that, though, let's talk about the majority of investment strategies for addressing healthcare. So if you look across the range of funds that are out there in the investment trust world or in the open-ended world, what you'll tend to find are funds that are focused either geographically on a particular part of the world or on a particular subcategory of healthcare. And most of those tend to be focused on medical devices or drugs or a subset of drugs, such as biotechnology, so the high innovation stuff. Now, that really reflects the reality of the opportunity set that we've had over the past 20 or so years, where the innovations that have come through have been in novel drugs and they have been in novel medical devices. They haven't really been about addressing the fundamentals of how healthcare works and whether or not it works, because the opportunities to change those things simply weren't there. So we have started with BB Healthcare back in 2016, essentially with a blank sheet of paper, and said, okay, there is now this opportunity to invest in this change in the healthcare paradigm. And I think the fund is unique in having this top-down thematic view as to how we think about healthcare and how we invest in it. So what we wanted to do was create a vehicle that provided investors with the opportunity to gain exposure to these things in a concentrated but diversified manner, with operationally geared exposures to these different aspects of healthcare that we'll talk about in a minute, that really aren't accessible by the kind of things that many of you that are listening today probably own in terms of your direct equity exposure, particularly if you have a UK-oriented portfolio, because as you'll know, the majority of the market cap of healthcare here in the UK is very large cap pharmaceuticals. We wanted to do this in the best possible structure that we could have in terms of operational flexibility, maximising the opportunity to enhance returns with gearing and all the other things, and that's an investment trust. And we wanted to do that with a structure that was as good as it could be. So we use an annual redemption as a discount control mechanism, and we have retained a board to manage the trust who are unusual in the sense of many of them have significant healthcare related experience, and they are actually compensated in shares, and those shares are locked up for a minimum of 3 years. So we've tried to achieve an optimal alignment of their interests with ours. We have a very clear fee structure, and we have a very transparent mandate. There are no private companies in here. It's all public equities. It's very liquid. It's very scalable. So let's come back to why you can't necessarily benefit from all of the changes that are going to happen with typical healthcare funds. So as I said, most of the funds that are around today are focused on pharmaceuticals, a subset of that which is biotechnology, or they're a medtech fund, or they're geographically oriented. Now, this is a pie chart of where the dollars actually get spent. This is for the US, but to be honest with you, it would look very similar for any OECD market. And what you can see is prescription drugs are around 10% of total healthcare expenditure. Other medical products, which is where you'll find a lot of the things that end up inside patients, you know, stents and shunts and all those sorts of things, hips and knees, that's around 4%. So if we think about many of the opportunities that you've had as investors to participate in healthcare, you've really been limiting yourself to something around 15% of the pie of addressable spending. And what we're talking about now is an opportunity set that includes the whole pie. Now, just to put this into perspective, drugs as an industry, the value of that globally is about $1.3 trillion. The healthcare industry globally is about $10 trillion. So if we're talking about companies that can deliver savings on a percentage of total healthcare expenditure, then you can see the addressable market opportunity around this is very, very interesting indeed. And that's why we wanted to launch this new strategy back in 2016 to give investors the opportunity to participate in this much broader opportunity set that we saw was now accessible to public equity investors. So let's talk a little bit about what healthcare has to look like moving forward in order to meet the needs of society. So firstly, sorry, I keep accidentally moving forward more than one slide. Spoiling my own presentation here. Right, sorry. So 10 key things. Firstly, everything has to be completely different, because what we have right now is not scalable, it's not efficient, and any of you that have used the NHS in the recent past will know is not particularly good either. So we need to have something that really reflects the demographic reality of the patients that we serve, the pressures that creates, and the services that requires. We don't have enough skilled human people to do the work in the way we're doing it now. We're never going to have enough of those people. You know, the gaps in productivity and the gaps in staffing at the NHS are certainly not a new thing. It's been like that for many, many decades. Now, many of the changes that we're talking about, the enabling technologies for all of this to happen, are related to innovations in IT. So if you think about the world today versus 10 years ago, we're all walking around with a supercomputer in our pocket connected to the cloud. It enables us to interact with other people and other systems in ways we couldn't do previously, but also for those systems to interact with us in ways that you couldn't imagine. And any of you who are wearing an Apple Watch or a Fitbit or anything like that will know exactly what I mean. We need to be realistic and pragmatic about the world that we actually live in. And you know, the reality is that healthcare utilization is not even across the population. Certain people, because of poverty, because of genetic factors that they can't control, because of lifestyle choices, they are going to be much more significant burdens on the system and consumers of the services in the future than others. And we need to move to a much more focused and preventative approach to managing those people. So Genetic data lies at the heart of this. We need to understand really from birth what people's genetic disease risk is, make them aware of that, and then provide the services that are required to keep them on the right track, keep them healthy throughout their lives as early as possible. The next point 4, is perhaps a little bit more controversial for some of you, but any of you who've tried to get an appointment with a GP, which has been difficult for some time, will know that these days much of what happens is you are first triaged, often through a digital appointment or a phone conversation. This is a necessary step to gate access. Bear in mind what I said earlier, 25% of all GP appointments in the UK are deemed not medically necessary after they've taken place. That's after they've cost the NHS £150. We need to stop that, and we need to make sure that the GP is available to see the people who really do need help, and other people are directed to other alternative services that are significantly cheaper and easier to access. Now, in addition to all of that, if you go electronic first, it creates a digital footprint. It enables us to follow somebody through the system and make sure that they get the care that they need, and also don't get care that they don't need, so we can optimize outcomes for the money that we spend. Related to this point about getting the care that you need, we also need to acknowledge that people are fallible. We all do things we shouldn't do, and we all don't do things that we should do. So I'm sure everybody on this call never smokes, only eats healthy foods. I'm sure you all exercise regularly, you don't drink either, and I'm certain that's what you tell your doctor when they ask you. But the reality is we're all prone to the odd slippage here and there, and you probably recall the last time you were given some pills by your doctor or some cream, or you were told to do some physiotherapy exercises or something like that. And I'm sure you were incredibly diligent with these things for a small period of time, but then you weren't. And when we think about a world of chronic diseases, so a chronic disease is something you can't cure, you have to live with for the rest of your life, it becomes harder and harder to do that. You're being asked to take pills to prevent you having a heart attack 10 years down the line. Those pills don't make you feel any better. So we need to recognize that people are fallible and help them do better in complying with best medical practice to keep them healthy. Related to that, we need to empower them. We need to help them understand why we're asking them to do things, and make them feel engaged in doing those things. One of the challenges you've seen through the pandemic, for example, is that there is a hardcore of people out there, around 5 million adults in the UK, who simply don't want to get vaccinated, many of them because they don't understand the benefits of vaccination in terms of them protecting themselves. And this is really all about a lack of knowledge. So we need to help people be more engaged, not talk down to them, and understand why we're asking them to do certain things. We need to lower the cost of the point of care. I'm sure many of you have been to a hospital. I'm sure none of you like hospitals. They're horrible places. They're very expensive, and they're full of sick people. No one wants to be in them. And in the modern world, we don't need to do that. It's quite possible for lots of things for people to receive care at home. And that is the direction that the world is going to move in. It's the direction that consumers want it to move in. Now, the other thing that's worth talking about is this idea of connected care. I'm sure you're familiar with the Internet of Things. I have a new kitchen in my house. Every appliance has the opportunity for me to put some app on my phone so that I can control it or receive information about it. Quite what I need to know about my fridge and what it's doing when I'm not in the house is beyond me, but the opportunity is there nonetheless. When you take this into the hospital setting, it becomes much more interesting. So every new medical device that you buy that sits by the side of a bed or in an operating theatre has that same level of connectivity. And when you start wiring those things up to the hospital internet, it enables you as the manager of a hospital to control everything, reallocate staffing, allocate resources in a much, much more efficient way that was never possible before. And this is going to be very, very important moving forward. We actually have the first fully connected hospital in the UK. It's in Leicester. It has like a mission control center that's staffed with specialist consultants so that everybody has the opportunity to access second opinions in real time and all those sorts of things. That again is the direction that the world is going to move in. Now, related to this, two other things. The first is that, and we think this is a very important thing, what we call the democratization of innovation. So pretty much all the things that I'm talking about so far, you will all recognize that you're not going to get those from GlaxoSmithKline or Smith & Nephew or AstraZeneca. They're going to come from companies you probably haven't heard of, based in places you're probably not aware of. And this is a really, really critical point. The way that healthcare is regulated has changed, the opportunities have changed, and therefore the companies that you need to invest in have changed. And related to that as well, because the system is going to change profoundly compared to what it looked like in the past, that also means that the companies that are going to deliver success in the future are a different suite of companies to the ones you've had in the past. So let's move on then to what I think is the most important slide in this presentation. This is our sort of go-to-market slide. It's a pictographical representation of the modern world. So hopefully we're all in that green box on the left-hand side. Regardless of our lifestyles, at a certain point of time, we will all get sick. We will seek a diagnosis. The doctor will try and identify what is wrong with us, hopefully correctly, sometimes incorrectly. And we will be given some kind of treatment program, which we will be asked to stick to and then hopefully recover. But because of all the things we talked about before, that diagnosis isn't perfect. Those treatment outcomes tend to be focused on relieving symptoms rather than addressing the underlying disease. In many cases, it's chronic and we couldn't address it anyway. And therefore, the recovery that you get in the real world because of fallible people is not optimal. So at a certain point of time, you will relapse, you will have a recurrence of your symptoms, and the whole process begins all over again. Now on this slide, you can see there are 21 bullet points. Those 21 bullet points are products, services, and technologies that exist today already that have been demonstrated to improve the quality of care or lower the cost of care. And all of them are featured in our portfolio. So simply put, if you invest in BB Healthcare, what you are getting is operationally geared exposure to the bullet points on this portfolio. We're not interested in what's in the benchmark or what anybody else is doing or particular subsectors or categorizations or anything like that. We are simply looking to try and get as balanced from a risk reward perspective as possible, maximal exposure to all of those bullet points within the investable universe of companies out there across the globe. Now, what this means in terms of a portfolio is if you look at the companies that are in our portfolio, and we've just given you a couple of examples of things that are either in it at the moment or have been in it in the recent past, you will see it isn't your GlaxoSmithKline's, your AstraZeneca's, and so on and so forth. So hopefully many of you haven't heard of the majority of these companies. And that's kind of the point, really, isn't it? That's why you pick a specialist active manager, to give you exposure to things that you couldn't necessarily identify yourself or own through direct equity participation. Now, what does this mean in terms of a portfolio? So as I say, we run a concentrated portfolio of companies. They are not in any way correlated or linked to the benchmark. So you end up with something that looks very, very different. So we can only have a maximum of 35 holdings in our product. We have 32 in this slide. It's actually down to 30 at the moment. It's very concentrated, so over half is in the top 10. Very high active share, so it's pretty much been over 90% as an average over the lifetime of the product, and more than half of it is outside the most commonly used healthcare benchmark. So you'll see a very limited overlap between our fund and any of our peers. As a consequence of those factors, the performance is also very uncorrelated to the benchmark. And if you want correlated benchmark results, then go buy an ETF and save yourself a lot of money. If we look at market cap exposure, as I said, we're looking to get operationally geared exposure. That means we eschew conglomerates. We're never going to own Novartis or Johnson & Johnson or something like that. We are looking for companies who are focused on delivering products that specifically address those bullet points that I talked about. And consequently, that means we're much more small mid-cap focused. We're very focused on the US. The US is, and is likely to remain for some time, the principal site for innovation in healthcare because of the ecosystem there from a venture capital point of view and also from a regulatory point of view. Just a word about healthcare generally in a second, but just to summarize what this means as well. You can see on this slide our top 10 summarized here, but also our subsector allocation. Now, because we are unconstrained, and this is a key aspect of our strategy as well, we are free to roam about healthcare to maximize those returns and minimize risk in the way that we think is appropriate. What that means is we can, of course, have zero exposure to certain subsectors, and we're very, very happy to do that. And equally, we're happy to have completely different exposures to everything that's in the benchmark. And hopefully this slide makes that very, very clear. Now, if we think about healthcare as an industry, with the notable exception of tech, which has been, a secular growth trend for a long time now, what you can see hopefully on this slide is that healthcare, because of the secular demographically driven growth trend and innovation that we talked about, it has consistently been an outperformer versus the wider marketplace, and certainly versus some of those dependable sectors that people tend to focus on, like consumer staples and things like that. So technology has obviously been the place to be for the last 10-15 years, but if we look at the next best place to be, it has been healthcare, and because of the trends that we've talked about, we think that will remain the case moving forward for many years to come. Now let's talk a bit about performance. So here you can see the performance of the BB Healthcare Trust. So we have two real things that we focus on in terms of performance. The first is to beat the MSCI World Healthcare on a rolling 3-year basis, and the second is to deliver a double-digit annualized return over that rolling 3-year period. And you can see that we have done those two things since the inception of the fund. We have also grown as a fund quite significantly. So we launched at 150 million back in 2016. We're now 1.15 billion. We've grown through a combination of performance, but also from additional issuance. We have a regular tap program that enables people to get into the fund very easily and provide liquidity and so on. We're very happy for the fund to continue to grow for the simple reason that because it's a highly liquid strategy, it's very easy for us to scale. And we've tried to illustrate that on this slide. So what we're trying to say here, what we're saying is the fund could be twice as big as it is today, and we wouldn't need to find other investments to invest in. We could simply prorate up what we have to that scale. Now, I just want to talk about dividends. Dividends are probably something for many of you as retail investors you're very interested in. And if you're a healthcare, if you're invested in healthcare, particularly here in the UK, then you'll be very aware that GlaxoSmithKline and Astra have both paid very significant dividends. Now, my thought about dividends is if they are important to you, you want them to be progressive. So you want them to be material, but you also want them to grow. And that is not something that the large pharma companies have been in a position to do. As you can see from the current forecasts that are out there in the market, that's not something you can realistically expect is going to happen in the future either, because dividends are a big problem for pharma companies. And the reason they're a problem is that R&D is quite difficult. It doesn't scale very easily. And where the cutting edge of healthcare is continually changing. So what happens is large pharma companies have to continually refresh their portfolios by buying in new ideas, new people from outside. Roughly a third of all products launched by big pharma are actually invented elsewhere. This requires capital, and therefore if you put yourself in a position where you spend all your cash flow on paying dividends to shareholders, you don't have that capital, and therefore you can't do those things. And I think Glaxo stands as the apotheosis of this. Massive dividend payout, no M&A, no innovation, no growth, therefore no dividend growth. And this cycle is likely to continue until these companies get themselves in a position where the dividend is no longer a millstone around their neck. Astra has managed to do that. Glaxo is going to do that by cutting its dividend, as you may be aware, when it separates its consumer business. So we think dividends are not something that you should be looking at when you choose healthcare investments. We do recognise they're important to retail investors. So what we do is we pay a dividend out of capital, 3.5% of the trailing NAV at the end of each year. And that leaves us in a position to provide a decent level of income, but also to be unconstrained in terms of the companies that we pick. Because if you actually look at the healthcare sector, around a third of the companies in the MSCI benchmark, they don't pay a dividend at all. And if you look at the dividend yield because of that third that don't pay, it's actually not very high. So this gives us the freedom to provide you with that dividend income that you want, but in a way that gives us the freedom to invest in companies that are going to actually make you decent total returns over time. So in summary then, we think healthcare is the secular growth story of our age because of demographics. More people, more wealth, more scientific progress means there will be ever more things to spend other people's money on when it comes to healthcare. But that is the problem here. It's generally somebody else's money. So therefore, society has to think about this slightly differently and find ways to do it more efficiently and more effectively so that there is enough money to pay for all of the things that we will rightfully expect will be there for us in the future when we need them. The great news for society and the great news for you as an investor is the tools to deliver that totally different healthcare experience are here. It's just a question of moving toward them and implementing them over time. But you need to recognize as well that they're not going to be delivered by the companies that historically you've tended to focus on from an investment standpoint. Just to close out, I just want to talk about the current dynamics in healthcare. So I'm sure you've been very aware particularly for the last 4 or 5 years, but really for the last 10 or 15 years, one of the big debates in healthcare investing is drug prices in America, which are undeniably higher than they are in the rest of the world, though probably not as high, relatively speaking, as politicians in America would have the American people believe. And this is very much a hot button issue. So in a country where politics is polarized, you need to find something in the middle that everybody wants to listen to, and drug pricing is one of those topics. So when Biden became president, there was a significant worry, unjustified in our view, that the progressive wing, the left wing, if you like, of the Democratic Party, would try and push through some very aggressive moves against the industry. And this has sort of hung over it as a Damoclean threat for quite some time. Now, the reality is Congress is very finely balanced, and there simply isn't the mandate to push through contentious legislation, because everything needs some degree of Republican support, if you like, in order to pass. So what we've seen in the last sort of 72 hours is the scaled back version of the Build Back Better bill, which is a very comprehensive budget reconciliation bill in America. Started off as $3.5 trillion down to $1.75 trillion. Started off with no drug related stuff, but then Bernie Sanders, who's a blowhard and in charge of the budget process, he sort of said, no, we're gonna jack something into the bill and we're going to force it through Congress. Well, yesterday we actually got to see the measures. They're very, very modest in scope, and small biotechnology and innovative companies are largely protected from those. Now, if you look at the last 6 months, the healthcare sector has behaved very unusually, which is the small companies have significantly underperformed the large ones. And that doesn't usually happen, because generally this is a growth sector and innovation is rewarded. And there's much more innovation in the small companies than the big ones. So it's been a very, very unusual dynamic. And it's been born of a reluctance, I think, for generalist investors to pile into biotech and innovative healthcare, because they were worried about the potential ramifications of political action in the US. Now that we know what we're dealing with, we saw the beginnings of this yesterday with the strong recovery in some of the small mid-cap healthcare sectors. And when I left my desk to come here and present to you guys, that was in evidence again this morning. I think that will be the trend over the next few months. So I think this is a very opportune time to look again at healthcare, look again at the opportunities, and potentially ride that wave of a more normal investing environment, which certainly isn't what we've had over the past 6 months. And with that, I'm very happy to take any of your questions, and thank you for listening.
Thanks very much, Paul. The news from the US yesterday, has that led to any specific changes in the portfolio so far?
Well, no, we don't. We very much focus on a longer term, 3 to 5 year investment horizon. We certainly don't react to day-to-day news flow in any meaningful way. But what I would characterize as the situation in the last 6 months, and we've written about this quite a lot in our fact sheets. If any of you are interested in the fund, we write these quite discursive fact sheets talking about what's going on in the market. So really, as I say, we've had this unusual 6-month-long trend now of small cap healthcare underperforming, and people saying, I'm worried about the FDA and whether or not it's still approving things in the same way as it was before. I'm worried about the Federal Trade Commission under Lina Khan and Biden, and whether or not they're going to prevent M&A. And therefore, I feel much safer in my Pfizers and my Johnson & Johnsons and so on. So you've seen large cap healthcare perform well, which is fine, but the small cap stuff generally be largely ignored. And as I say, that's a very, very unusual dynamic, but it's one that's persisted for quite a period of time. So the discussion, everything we get back from other investors, other fund managers, when we talk to them, analysts and so on, has been very much about this people are simply too worried about the political environment. So now I think we've jumped this bogey of what are the Democrats actually going to do. Logically, you always knew they couldn't do very much, but finally we've seen it, and I think it's going to enable people to move on. One of the challenges for us all over the last year has been there's been so much going on as we've come out of the pandemic and been thinking more about normalization and recovery. There's so many things for investors to think about that when something looks complicated and uncertain, they just simply say, I don't want to do that right now. I'm going to move on somewhere else. And with so many opportunities around the reopening, I think that's exactly what's happened. So we've been continuing to buy the dip, for want of a better word, and invest in the things that we're very confident on that 3 and 5 year view. What I think is going to happen now is that we're going to get the reward for that we've been patiently waiting for.
Great. And just going back to one of your slides, which showed obviously tech being in the ascendant. How obviously you're investing into sort of pretty innovative companies that have got strong growth prospects. How correlated are, and maybe this is part of the biotech question as well. How correlated are your stocks, your sort of innovative growing stocks, to the sort of tech sector? If they catch a cold, do you catch a cold too?
I think to a degree they do. I mean, because inevitably a lot of the investing that's going on now, as you know, is driven in baskets of ETFs and things like that. And if you have a Nasdaq ETF, a Russell 2000 ETF, Russell being a small cap growth index in the US, for example, then of course there's going to be an element of healthcare caught up in there with all the other tech stuff. So yes, I think there's a degree of contagion, and I think that's been one of the challenges. Generally when the Nasdaq's selling off because people are selling, I don't know, Facebook or whatever it might be, then it's the case that some of the other Nasdaq stuff gets caught in the wake, and that will of course include all the biotech things that you're referring to. So I think there's been a degree of that. Yes, that's true.
What proportion? So there's lots of questions about, which I think is answered in one of your slides actually, but it was quite a small part of the slide. What percentage are the trusted in sort of small and mid caps, and what percentage are ones that pay a dividend yield, a meaningful dividend yield? And
yeah, so the answer to the dividend yield question is that the dividend yield of our portfolio is about 60 to 80 basis points historically. I must admit it's not something I particularly focus on, so I'd hesitate to say whereabouts we are with that right now, but that's generally where we are. So effectively negligible. And if you think about an investment trust where you legally have to allocate some of your costs to the income account and some to the capital account, by the time you've done that, you should effectively conclude that there is no organic yield from this product. So our dividend is a manufactured dividend that comes from capital, as I said, and I think the reasons why we do that are quite clear. Now, when we talk about small and mid cap, it's worth bearing in mind that our definition of small and mid cap will be very, very different to small and mid cap managers in other areas. Healthcare is a multi-trillion-dollar industry, and that's reflected in some absolutely gargantuan market caps. So our idea of mega cap is over 50 billion. Our idea of large cap is over 10, and there is nothing in our fund that has a market cap of less than $1 billion. So when we talk about small and mid cap, we are talking in that $1 to $10 billion range, which is still pretty big companies. You're knocking on the in the middle of that. You're certainly knocking on the door of being in the FTSE 100, for example. So I just want to make clear that when we talk about small and mid cap, that's what we mean. But it's worth bearing in mind, if you look on the slide that's up at the benchmark, those mega cap, those $50 billion plus companies, they account for 3/4 of that benchmark. And there are some absolutely behemoth companies in there. They're in the hundreds of billions of dollars range. And they're the companies that we really don't want to own, for the simple reason that if you have a $40-50 billion top line, if you have some fantastic idea that opens up an opportunity that's in the several $billion-dollar range, it's not going to move the needle on your financials, and therefore the market's not going to reward you for it. Whereas if you focus on companies that are obviously much smaller, and they do deliver products that address these very large theoretical markets and enable them to make hundreds of millions of dollars in revenue on the back of those things as they come to fruition, then those companies will be rewarded because they're of a scale where that's actually a meaningful difference. And that's what really drives our thinking here. We're very focused on liquidity because liquidity is important, particularly if you have an annual redemption option. I think you're obliged to run a liquid portfolio so people can be confident in that. But what we want is that operational gearing, so that when the work that we've done that's led us to invest in a particular company, when it comes to fruition, that the rewards that will accrue to investors are meaningful.
Thanks, Paul. There's some sort of fairly specific questions about having exposure to. Do you have exposure to gene sequencing apart from Illumina? And obviously, and perhaps related to this is what percentage of your companies are sort of loss-making new businesses or ones that are established with cash flow? I mean, again, I don't know whether they are linked because I'm not an expert about Illumina, but
let's take the latter one first. So off the top of my head, probably about 15 to 20% of the portfolio is in what we would call pre-commercial companies. So they're companies that are, at that stage of launching things, but they are certainly not at a point where the revenues they're generating from the products or services they provide are actually resulting in net positive cash flow for the business. Now, we are not an early stage investment focused trust. We are a conviction investing across diversified healthcare. So the way we think about these things is we are looking to buy companies who are on kind of that hockey stick inflection point with their products, technologies and services in terms of mass adoption. So when we think about that from a clinical point of view, we don't do blue sky stuff. We do, phase 2 or better, where you've demonstrated that the idea has clinical utility. You've done a reasonable amount of work, or you're able to do a reasonable amount of work around the cost benefit of the product were it to be approved. And then we can take a view on approvability for that last stage of clinical development. Or if it's a medical device, we're more likely to be it's on the market and the company's running the study that's going to demonstrate that it improves outcomes or saves money versus the current standard of care, whatever kind of product or procedure that that particular company might be addressing. So I would emphasize that I wouldn't think of us as sort of super early stage investors. That having been said, within the portfolio, you saw that in the top 10, for example, we do have some companies that are reasonably early stage in terms of having one or two products or focusing on some pretty kind of blue sky stuff. Let me just sort of zoom back to the portfolio slide. Where are we? Here. So you can see Sarepta at the bottom, for example. Sarepta is a company focused on something called muscular dystrophy, but they are unarguably, in our view, the most advanced company in gene therapy. Now, gene therapy is a very, very interesting idea that we've been monitoring for 5 years and only recently put into the portfolio because we simply thought it was unquantifiably difficult. It was just impossible, really, to work out whether or not it could be delivered as a genuine therapeutic modality to improve the lives of patients for all sorts of complicated reasons that I won't bore you all with. That has changed in our minds, and therefore we are prepared to make an investment. Now, it happens that Sarepta is already profitable in its core business, but it's spending so much money on gene therapy right now that all those profits get eaten away, but we are convinced that this has come of age and is kind of the right thing to do. Come back to the question about gene sequencing. We did have exposure to Illumina. We did have exposure to Pacific Biosciences. We do not have any exposure at all to gene sequencing right now, and that reflects some shifts that are going on in the industry, but the pretty crazy valuations of the companies that we think are the right side of that trade. So we don't want to own Illumina because they're trying to buy, well, they have bought Grail. We don't want to own Pacific Biosciences because the valuation is insane. And we definitely don't want to own Oxford Nanopore, which is the one that recently floated in the UK, because the valuation there, again, is just utterly mind-boggling. And our view is that Pacific is a much better company, for example. So our exposure to gene sequencing right now is zero, but it has been at various points through various companies, reasonably high in the past.
Hi, Paul. Time for probably a couple more if we're quick. Gearing policy on the trust and where you stand at the moment.
Yeah, sure. So gearing right now, we are very moderately geared. We're about 1.8%, something like that, of gross assets. We have committed at the IPO to run mid to high single-digit gearing over the lifetime of the product. That changed very significantly during the pandemic, where we ended up through the middle of it running quite a sizable cash buffer because we were concerned about all sorts of things, whether or not vaccines were going to work properly and all sorts of different things like that. But we remain committed to that mid to high single-digit ratio, and I would hope that the gearing will continue to increase as we move into the back end of the year.
Great, thank you. And then a nice final one. There's a few left. I'm sorry we haven't been able to get through them. What new area in the portfolio excites you most and the best future potential, in your opinion? Yeah,
sure. So when people ask me this question, the thing that I get most excited about generally is the diagnostics area and the movement toward what we call near patient testing, There's lots of companies doing what we call syndromic testing. So imagine you're a doctor, someone comes in, an old lady comes in the back of an ambulance, can't breathe. Because she can't breathe, she can't speak to you. She's exhibiting signs of respiratory distress. Has she got pneumonia? Has she got flu? Has she got RSV? Has she got COVID? Has she got some bacterial infection? You just don't even know. And you can waste a lot of time going through the differential diagnosis to get to the end of that. And in that meantime, that patient is deteriorating. Now, what you can also do is if you have a syndromic panel test, you can take a sample of sputum that this poor old lady is coughing up, you can put it in a machine, you can press a button, and an hour later, not only will it tell you what she's infected with, it will tell you the antibiotic resistance profile of what she's infected with if it's a bacteria, and you can get on with treating her as well as you can. And that sounds very, very simple because it is. And technologically, I think that's the single most exciting thing that we can do is we can be better at diagnosing people clearly and therefore initiate appropriate treatment earlier. And that's how you save huge amounts of money and huge amount of lives. So diagnostics, very, very excited about, it's been one of the most fertile areas for us in terms of returns for the portfolio since inception. I'm also, as you probably saw, very excited about gene therapy.
Great. Well, Paul, a very, very interesting area, clearly. And I'm sure there's lots more questions which we haven't answered. So I'm sorry to anyone who's been left unsatisfied. We've got BlackRock Frontiers presenting next at 3 o'clock. But thank you so much, Paul, on behalf of everyone who's dialed in. And thank you all for dialing in and listening to us as well. So thank you so much.
Bye-bye.
Cheers.